What's going on, everybody? Welcome in. Good morning, good evening, wherever you are. Another live stream here with the Everyday Growth Advisors. Remember that daylight savings just got switched back. So for me, the market opens 1 hour earlier now, which is nice. Finally at 9 p.m., which is actually a better timing for me personally. I do like this timing better, and I'm really looking forward to building a new schedule. Even that 1 hour makes a big difference for me, mainly because of my sleeping patterns and things like that. What a tide of events that have been happening through the weekend. A lot of chatter on FinTwit, and then also on all of the media outlets. Pretty much over the weekend, the Fed made a snap decision to pretty much provide a new facility so that this liquidity event that is happening with SVB and Signature Bank could be taken care of, and just the whole debacle can be kind of calmed down. Markets not really well, it initially did buy up and kind of provide a little bit of a cushion, but then futures sold off aggressively pre-market here to head into this 37.80 level, which is kind of playing out on the bearish plan from the newsletter. Now, obviously, from my perspective, I find this as a great opportunity for us to take advantage of fear and panic in the market. Remember, when everybody is running to the hills and screaming for blood, that's the moments I like to take exposure in the market and take on some of that liquidity, or rather provide liquidity to the system. Remember that your job is to be a market maker, or act like a market maker when everybody is behaving like a trader. And this is where you have to really hunker down and not listen to your emotions, and not cause yourself that panic to cause a lot more worry for yourself. So this is where you have to remain calm. Now let's go through a couple of important things that you guys have to know about this week. It is, after all, a huge week for financial markets. It is OPEC's week, and then also it is CPI week. Next week, we also have the FOMC meeting that's going to happen Tuesday and Wednesday. The market is currently pricing in a no rate hike for next week, mainly because of this situation that's happening right now. You can see that the yields for bonds have come way down, which means people are actually buying bonds because of this liquidity event. Obviously, a lot of investors are going to flock to safety, to risk-free assets in the short term. You can see that that 1-year treasury is still selling off here pretty aggressively, which is the reason why a lot of this panic is going on within equities. And honestly, this is not necessarily a bad thing. You just need to understand why things are happening, the way it's happening, so that you can kind of circumvent and move around your liquidity. So a lot of short-term buying in bonds. This is, you can see majority of affected the terms are mainly the 6-month, 1-year, 2-year, 3-year, all the way up to the 5-year. We're looking at this batch, the middle part of the bond market. The short term and the long term of the bond market, not saying that it's not affected, but less affected, right? And so we're seeing a lot of that liquidity fly into the middle term, or the middle term structure of the bond market. And when I say bond market here, I'm exclusively talking about treasuries, okay? Treasuries. And for those of you that don't know what I'm talking about, hey, guess what? Don't fret. We have a webinar coming up on the 26th of March. Make sure you sign up for it. We posted it on socials already. We're going to talk about the bond market. We're going to brief you on why and how to study bonds. How do you correlate these things, okay? So make sure you sign up for that webinar. But right now, this middle part of the bond market kind of seeing a lot of inflows, and in other words, people are buying bonds. That's the reason why the yields are falling. Remember that bonds are they move inversely from the yields, right? So as the price of the bond goes up, the yields start to come down. So this short-term fear and panic in the market, as along with, you can see the VIX up here at 30 already, is what is causing a lot of these investors to buy that short-term bonds. Okay. Now, other things that you need to know about this morning is mainly that the technicals aren't looking very hot right now. Now, obviously, this could be a scenario where we get bought up intraday after liquidity kind of gets pulled in. I would say that's closer to the 37.80 level, and we need to keep a very close watch there, because remember in January, in fact, from December to January, this 37.80 level was a very, very strong level for the S&P 500. We weren't able to break below it. It was a very, very strong level. So if we do lose this 37.80 level, then down we go to 3,700, and back down we go to 36.40, which is the key pivot for bears to control the market again. Okay, but do I see that happening this week? It's hard to tell. Tomorrow CPI is going to further cause more volatility, because that's going to give us another consensus reading on where inflation is going. And if the inflation numbers come in hot, then yes, you could probably say, we are probably going to go down and retest 3,700 and 36.40. But if CPI numbers come in as expected, that means as consensus or cooler than consensus, then we'll have to see by how much, and that's likely to cause a market spike either to the upside, or if it comes in as consensus, then we'll probably see a spike, but then also some sideways movement. Okay, either way, I'm going to put out a very, very important disclaimer for this week. You guys know, and I mentioned it on Friday as well. OPEX weeks are extremely unpredictable, okay? Because there's a lot of gamma that is slashing or swishing around. You need to understand that when all these positions are going to be unwound and unclenched, there's going to be a lot of ups and downs in the market. Market makers will be pushing their positions either up towards their strikes or down away from their strikes, trying to either hedge their continuing bets or cover existing bets so that they can get closer towards their strikes. So that you don't know how the market's incentivized, but just based on the data that I've seen, majority of the expiries are laying between 4,000 and 4,100, which is this area right here. Okay, that's where majority of call options and put options are. Okay, now does that mean that we can go up and get up here to push back against this? It is very possible if CPI data comes out favorable. If CPI doesn't come out favorable, then we are likely going to see continued downside exposure being taken on the market sometime at the market open today and tomorrow, heading into CPI. Okay, so you have to be aware of that and try to play around it. Now, remember, just keep it simple in terms of the technicals this week, right? As I have said on the newsletter. If we're able to clear back up in that 39.40 this week, then we're likely to continue seeing a fade all the way back down 37.80 and then 3700 and ultimately 36.40, right? Those are your three key pivot points on the bottom. If we do somehow get a big rally back up and then, you know, a big reversal here sometime, you know, at the open or in the market session today, then we really need to, bulls really need to pretty much capture 39.40 and start pressuring bears. There needs to be some kind of a squeeze intraday for us to get price action back up above 39.40. Above 39.40, this puts bulls in a better position to continue in this trend. And as I said last week, we can hang out here a couple of days before squeezing back in. It is very possible. Market has done this before. Okay, so as of right now, that's all you need to know in terms of the technicals. Remember, the two key pivots are going to be 39.40 and 37.80. 37.80 is a very, very key pivot, okay, to the downside. NASDAQ seeing obviously less outflow than the S&P 500, mainly because obviously financials are not a big part of this one. But you once again have to be wary of when NASDAQ starts to sell off. If NASDAQ starts to sell off aggressively, then down we go back, right? But if NASDAQ's not really able to pick up the steam here, remember, we are pretty far away compared to the S&P 500 from this bottom here. As you can see, once upon a time, NASDAQ was the one that was weak when S&P 500 bounced higher and financials were strong. We had this gap over here, and you can see that on NASDAQ we didn't have that gap when we came back down. Now you can see the roles are reversed, where financials are weak and NASDAQ is strong, so tech is actually leading, or rather relatively strong in terms of the market. You can see that it's pretty still far away from this bottom here with the NASDAQ versus the S&P 500. So if the market does recover, remember that the tech stocks and you know, anything to do with NASDAQ is going to see the first inflow of capital, because that's the sectors that are really much stronger in terms of relativity. Obviously, the market breadth is pretty washed out at the moment. I posted about this just I want to say 1 or 2 days ago. So you can see a lot of this market breadth, the liquidity premiums are all kind of smashed here. On top of that, you can see the breadth of the S&P 500 is completely washed out here. And so, you know, it makes a great case for some buys and taking some upside exposure. Personally, I will not be chasing any of this downside. There is no reason to. And for me, I have no incentive to take this downside trades until and unless we break 37.80 firmly, we break and we start moving aggressively down. Yes, sure, I'll place on 3700s and then I'll place on 3640s. But if we stay above this 37.80, I'll be looking for a nice bounce in this region for that upside play, 38.80 and 39.40 for that back retracement, back testing. Okay. Gold here seeing some inflows and overnight, you know, rally back up. IWM got absolutely demolished, mainly because obviously small caps and the smaller banks also are listed on IWM. So we saw a lot of IWM being sold, and this is actually a lot of what is driving the S&P 500 down as well. Remember that. And then you have the bonds that I already spoke about. The dollar also falling here. You must be wondering to yourself, how the heck is the dollar falling and then equities you know, still so weak? Well, the thing is, you got to realize that people are selling the dollar out of panic. Okay, they just don't want to. They're selling the dollar out of not wanting to hold exposure in that market, mainly because they're scared of market risk. So it's not always whenever a market liquidity event happens, or whenever there is fear and panic in the market, then the fundamentals or technicals don't start to work in the usual way that they're supposed to. When emotions take over, everything starts to sell. It doesn't matter what it is. Okay. XLF opening down at $32. You know, it's really a pity, because remember, we were actually short XLF here, and then when it started to rally, I closed out my long trade. And you know, if I would have held on just a week longer, god damn, guys, you know, what should I say? It's crazy, right? Actually, we actually kind of got it right, but you know what? I'm not gonna take credit for it, because I didn't hold it long enough. I had paper hands. I sold my XLF puts. If not, they would have paid insanely well, right? Okay, then the other sector that I'm looking at here for backtest entry into this downward descent is energy. XOP and XLE, or whichever energy stock that you're looking at, This is another play that you might want to be looking at this week. Okay, a backtest of 126 would be a really good spot to add some short exposure if we can get a nice rejection in this area. So I'll be looking for a nice buy up on the S&P 500, and then when that happens, I'll be ready to take some short trades on energy. I'm ready for that. Now, I've been talking about this for a while. If you guys have been attending live streaming, this pre-market sessions, you know that I've been talking about going bearish on energy for a while, and now we finally got the break. We gapped down pretty hard, $5 down actually. It's pretty massively bearish on this. So I want to take some exposure energy short when I get the opportunity here for a backtest at 126. I'll be looking for that entry and play down. If you guys have any charts that you guys want me to do, go ahead, put it in the chat right now, the comments right now, so that I can get to it. Or if you have questions, you have comments, you want me to answer something, go ahead, put it there. Or simply, if you're here and you're just enjoying the live this pre-market live session, go ahead and put that in the comments too. I love to hear from you guys. So, you know, whenever I hear from you guys, it's always nice. How are you guys doing? I hope that you're, you know, doing well. Don't panic. Remember that when you panic and you start, you know, trading beyond your means, then you are going to make stupid mistakes. So don't, you know, don't make that mistake. You know, we always got to ask about Tesla, morning Apple. Yep, you're right, Jeffrey. Okay, I'll do Tesla for you guys. All right, here we go. So Tesla key level this morning is going to be 167.25 or 167. Let's just call it 167 even, okay? 167 right here. A break below 167 would see that downside, but however, the thing is, this wave is pretty extended to the downside already, so we want to see some kind of a pullback action here in order to continue bearish on Tesla. However, I gotta say that if we do break below 167 with like continuation and it just keeps falling and falling and falling, then, you know, just I would take that bearish trade, because it depends on how much of fear and panic people start ensuing in the market at the market open. So 167 is really going to be the break point or the pivot point this AM to watch. Okay, so I'll be looking for this 167 pivot to the downside. 163 will probably be a first target, and then below that 155 or so, that will be the next one, and then below all of that will be 146. So I'll be looking for those two main points on Tesla. However, I would love instead to see this 167 bounce. That's the main play that I would want to take. 167 bounce should get us back into 180, 150. And so taking this upside exposure actually makes me feel a lot better, makes me think a little better, because remember, tech is relatively strong against the market. I would like to instead take the 167 bounce. So if we get that 167 bounce and a strong, nice bounce in this area, then I would want to first start play some 175 calls, and then eventually some 180 calls. If I can roll up and up and up and then get up to 185, if we get that price action until Wednesday, then I would rather take that trade. I see, honestly, the risk to reward ratio opportunity on both sides being the same, because the downside risk to reward ratio is the same as the upside risk to reward ratio. I would play it based on what I see in the price action, but it's always good to know the key pivot points, which is going to be 167 is where it's going to be either bullish or bearish. So watch that one closely, and that will be important. With Apple, we have this very big downward kind of channel that has formed, right? You can see that, right? And then a lot of consolidation and more consolidation here. Apple hasn't really sold off aggressively just yet, which is a good sign, right? I would think it's a good sign. Majority of the selling that you're seeing has happened across the financial sector and energy sector this morning. In fact, you can see right here, you can see that the financial sector, so energy, oh wait, it hasn't updated yet. Financials are down 3% and energy is down 3%. Both of these sectors are down 3%. That's what's causing a lot of the mayhem. You can see like things like healthcare are actually up 0.3%. In fact, even consumer staples are up or flat, right? Consumer discretionary is kind of flat, no, down 1%, not really flat. Materials kind of down 0.5%. Industrials down just a little bit here, a little bit here, a little bit here, right? And then you have retail that is also down 2%. So a lot of the outflow is on retail, financials, energy. Technology is barely down. You can see a 0.25% only comparatively to the rest of it. So you got to know where the outflow is. It's retail, financials, energy. These are the three sectors that have seen major outflow this morning. And we'll be looking for either continuations into them or bounces into them. Consumer discretionary, not really one of them. Remember, Tesla is part of the consumer discretionary sector. So we'll be looking for that bounce at this level or breakdown and play it either way. Apple, remember, since technology has not seen much of outflow this morning, might be a bounce back sector. And so if that's the case, then we'll be looking for a potential sweep of Apple down to the 144 or a bounce in this area back up. So I would, however, like to see that bounce back up. You can see it's kind of an inverse head and shoulder here with Apple. I think I pointed this out to you guys before. There's that left shoulder, right shoulder situation going on. And you have kind of that neckline right here with Apple. So if we do buy up here and start moving up to this 157 level, then the breakout level is going to be kind of here. And also, on the other hand, it hasn't completed this wave to touch this top trend line. So that might be a magnet point for Apple to start rallying here. And Apple starts to rally, it's going to pull the rest of the market up with it. So that's kind of the my thesis with Apple here, or rather tech stocks in general, this AM. Next up, the second biggest market cap is Microsoft, and you can see that even Microsoft has not sold off. In fact, it's up pre-market, which is something that obviously should be on your radar. And this thing has broken out of this huge falling wedge pattern and has been consolidating below here for, I want to say, about a whole month, a whole ass month, right? Since February 10th, it's been consolidating until March now. So, this could be a much broader breakout on Microsoft at some point. So we'll be watching Microsoft here for this possible bounce. My key pivot for Microsoft is going to be 251 or 252 roughly for that big upward move. So I'll be watching that closely as well. I appreciate the macro perspective. Thanks for sharing. No problem, Harshita. Hope you're doing well. Nice to hear from you. Anybody else that needs any charts broken down? Oh, by the way, I just wanted to point out something important was BABA. Remember, we spoke about BABA many weeks back. I've been giving you guys updates on it, and I told you guys there were 3 key points, right? First point, second point, third point. We broke below the second point. We've been moving further down here. It is time to add some exposure. We're getting very close to it now. So if you're a person who's been looking for exposure in China and you haven't added BABA to your portfolio, you've been looking for the time to add it, you don't know when is the right time to add it, this is the time to add it, okay? Remember that left shoulder formed, the bottom head formed, and now the right shoulder is forming. So this is the spot here where you want to add some exposure. Remember, I'm not saying that this is where we reverse. I'm saying that this is a good spot to add a first tranche, right? As I mentioned, not always are you going to get the right moments to enter certain stocks, but this is the spot where you can take exposure on your first tranche if you want to add BABA. Okay. Anytime between here and $77, you can add this thing. Oxy. Okay, let's have a look. Oxy. So I know a lot of you might be looking at this one, and here's the funny thing. It also looks very inverse head and shoulder-ish, if it can form a shoulder here. But it does look like it has a little bit of downside first before it gets there. Maybe not a perfect head and shoulder. But on the weekly chart, this is a very key support zone, and it does look like a potential level at which we could chop. I think Oxy is bearish below 54, like basically below this level here, I would say, right? This is a key level here for it. 50, I would take initial positions below 54.30 for a bearish play. If it bounces in this region and doesn't break below it firmly, then obviously it stays to the upside. So I don't want to play this within the chop. If it breaks below, that's the only way I'll play it. If it bounces, then you could take the upside trade. But I don't think this is a nice setup for, if you're looking at it just from the perspective of like, I want to trade this. Because it's just moving sideways. And as an options trader, if you're playing this range, sure. But you need to wait for it to come to one side. So wait for it to come to the 55, 52, 50 range before taking that upside exposure. That means it has a little bit of downside exposure before it does that. And so that would be my main thing here with Oxy. I would be watching for a bounce in this demand zone here. to take that, and then that will give me a better risk-reward ratio favored trade here, right? So you'd only pretty much take on this amount of risk, right? You could control that risk and have a very small risk, and then have all of this upside here for you to kind of benefit on. That's going to be like a 1:3 or 1:4 risk-to-reward ratio. So that's how I would play that one. So yeah, I hope that's helpful. Thank you. No problem. You're welcome. Yes. So yeah, that's all. Then also, JP Morgan got bought up pretty aggressively last week as well, but then Goldman Sachs got sold off. So be looking for a possible continuation here in Goldman Sachs. Goldman Sachs has got a pretty big market cap, so I'll be watching this one closely today for a potential buy up here, because JP Morgan did get bought up, and you know, pre-markets, it's not bleeding as much as its pals. So that's what I would be looking at. There's a lot of pockets of market opportunity. Like, for example, Marvel Semiconductors. This is another one that has been on a very big downtrend here that I'm also looking at. And it's popped up and now starting to come here, you know, at around this $36 level. I would love to take some upside exposure. It might be ready even here to possibly take some upside exposure, but you're going to need to buy some time. So that's all I have for you guys today. I'm going to repeat one thing very, very importantly, because I'm going to tell you guys, this is super important, okay? Do not trade this week excessively. It is going to be very choppy. If you're not, if you've not been doing this for a long time, you don't know how OPEX works, you don't know how the weeks go during an OPEX week, and you're unsure on market conditions, and you're just speculating, this is not the week to speculate, okay? This is not the week to speculate. I repeat, please save your money for either the week after or don't trade this week, okay? Because it's going to be very messy and very choppy this week. I've mentioned this like 5 million times to people when OPEX week comes along. Not to mention, this week is $2.8 trillion expiring of notional value. So you have to be really careful, okay? Stay out if you don't know what's going on, and then come back in when you are more sure. The market will be here, okay? Remember that. So keep your head on straight, keep your chin up, and I wish you guys a good day of trading. I'm going to jump on the Discord to trade live with the team right now. Remember, 14 days still available if you want to come and trial us out. Link is in the description. I'll see you on the trading floor. Till then, take care. Peace out. See you on Wednesday. Love you all.